Hello, and welcome to Legal Essentials by Exponent Philanthropy. Exponent Philanthropy is the country's largest association of funders and the only one dedicated to serving foundations with few or no staff, philanthropic families, and individual donors. Our vibrant network has in common lean operations and a style of philanthropy motivated by personal passion, community needs, and a strong desire for better outcomes. We provide high quality and cost effective programs, resources, and connections that maximize our members' dollars and time for the benefit of diverse communities and causes. Today, you're joining for Module 2 of the 3-part Legal Essentials virtual seminar. By the end of this session, you should be able to understand the grants to take additional steps to remain compliant with the IRS. If you missed Module 1, the recording is available to you so you can catch up. The final module in 2 days will take a deep dive into self-dealing and conflicts of interest. And like I said, Module 1 and all of the sessions will be recorded and will be available to you until August 31st, 2019. I'm Althea Georgantis, Program Manager at Exponent Philanthropy. I'm here in our DC office with my colleague Madeline, who will be helping out with your questions today. We are recording this webinar and it will be made available to you, as I said, along with a copy of these slides. If you would like the slides now, you've already been sent a link to them in the same email that had the link you clicked to join today. So whatever you click to get onto the webinar, at the bottom of that email, there's a link to the PDF version of these slides. And most of you already know the score for Module 1, but I do want to do a quick overview of how we'll be using Zoom today. Depending on the version of Zoom you're using, your controls will either be here in the top left or down in the lower middle of your window. I want to highlight that audio settings button. That's where you can adjust your listening options. If your internet connection is unstable, you can always call in by phone to get a better connection of the audio. And then I also want to highlight that chat function, which is how we'll receive all participant comments and questions today. Those of you who already participated in Module 1, remember, we did all the questions in the chat box. If anyone's new, if you want to practice, you can go ahead and enter in your foundation name and location into the chat box and say hello to make sure that you know how that chat works. Our speaker today is Andras Kosaris, joining us from Arnold and Porter here in DC. Andras represents domestic and international tax-exempt organizations on a broad range of regulatory, transactional, and operational matters. He also represents individuals and corporate donors on charitable giving. He advises exempt organizations on executive compensation, private foundation rules, unrelated business income tax, mergers, joint ventures, and the establishment of for-profit subsidiaries, as well as on managing investments and endowments, including mission and program-related investments. He advises exempt organizations involved in tax and governance controversies, including international investigations, disputes over charitable gifts and gift restrictions, internal investigations, and examinations by the IRS and state charity regulators. And with that, I will pass it over to Andras to get us started.
Thank you, Althea, and welcome everyone. So today we're going to cover grant making for foundations, and we have broken it up into a few categories. So we'll talk a little bit about grant making basics. Let's just go back here. And then grants that take not too much effort, that can be done fairly simply. Then the types of grants that require a bit more due diligence and a few extra things to keep in mind. And then we'll talk about advocacy and lobbying. That's always an area that comes up. And then finish off with just talking a little bit about having a policy related to grant making. Okay, so just as a reminder, grant making basics, and I think you probably covered this for those of you who were at the last session about the overall overview of foundations. But with respect to grants, there is a minimum distribution requirement for non-operating foundations, which roughly translates to 5% of net assets that must be paid out in qualifying distributions. each year. And this generally includes, all charitable grants, as well as reasonable and necessary administrative expenses relating to the grant making of the foundation and foundation management. You may also are familiar with program-related investments, which are a hybrid between grants and investments that are for charitable purposes. Those also count toward your payout requirement. And then there are the costs and time incurred on investment management does not count toward the payout requirement. So that's one of those things that's specifically excluded from the 5%. So all the costs and expenses that are incurred by investment managers are excluded. And then a quick tip and a reminder that grants may be distributed in both cash or in securities. You could give a grantee $100,000 in cash as a grant, or you could give them stock in IBM of the equivalent value. It often does not make too much of a difference. Sometimes a foundation may be able to save a little bit on the 1%, 2% excise tax on that investment income if you make a grant in the securities for the grantee to then sell those securities, turn it into cash, because that 1%, 2% excise tax does not apply to your grantees as public charities. Something to keep in mind. I can sometimes save a little bit of money. Grants with few steps. Okay. So these are basically two categories, right? You're basically your public charities. The 509A1 are your publicly supported charitable organizations, public charities. 509A2s are the what we sometimes call fee-based charities, where a significant amount of annual revenue comes in through fees for services. This could be the art museum, the theater, cultural institutions, and other types of organizations. They're all treated as public charities, and you can give them a check. You can write a check to them for the grant, and that's it. You don't have to include a written grant agreement or anything. It can be very simple. Now, of course, having said that, here we're talking about legal compliance, right? What you have to do in terms of the legal requirements. So that's very simple, not necessarily programmatic efficiency and making the grantees programs work well. Same thing for grants to government. You could actually write simply a check to government. Few foundations actually do that. Typically, when you do give a grant to government, it is useful, although not required, again, to have a grant agreement that discusses what sort of projects and things you're funding. Again, a scenario that's usually infrequent, but sometimes comes up when you might be funding something in collaboration with a government agency, and funding happens to go through a government agency for a larger project. And so let me just stop for a moment for question. One question came in about whether the investment expenses that I mentioned with respect to payout, just to back up for a few slides, whether that includes wealth managers only, or does it also include legal and accounting expenses? And those are for the investment management that does include, it can include related legal and accounting expenses. The same thing, for example, the portion of costs that the foundation may incur. Let's say you have a special session or a subcommittee that's handling investment oversight on the board. and you have a subcommittee of the board and you give them an extra stipend, or you need them to come in for an extra meeting, the costs and expenses incurred for that meeting would not count toward payout because it would be related to the investment management of the foundation. That's a good question. Tipping. So even though we have some easy, we're still in the easy category of grant making. One note about tipping, a question that we often get, and what this is that you have to be careful if you are giving a particularly large grant from your foundation that may affect the public charity status of your grantee. Now, tipping is not as significant a concern as it used to be. The IRS has fiddled around with the rules overall over the years, and a foundation has to simply be aware that a grantee may end up being tipped. It's usually not going to affect the foundation itself, but then it can impact other individual funders, other foundation funders down the road. So it's a conversation to have if, as you're doing your due diligence on a grantee, look at their 990 and take a look at their public support test percentage on Schedule A. And if they're close to the line, if the 33% on that Schedule A, take a look and have a conversation with them as how it can be managed. Maybe you can classify it as an unusual grant, or maybe manage it in another way. But it's something to be aware of. Let me just back up pause again for a question here. And there was a question about tribal governments, and those are recognized as basically the equivalent of public charities for purposes of these grant-making rules. And then one more question. Again, back to the tipping. So public charities have to meet a 33% test. There are a couple of good IRS researches about that, but that's what you want to look at. And I think about that. We can come back to tipping maybe at the end if there are more questions about tipping. But again, the point is that it's something to be aware of, and it's not going to be an issue where the foundation itself is going to be penalized for it. And it's also something that the public charity should be aware, the grantee should be aware as well. If they're asking for a particularly large grant from you, it's a conversation that they should be bringing up as well. Okay, next, grants with extra steps. Grants to non-501c3s. Can everyone hear me? I just want to make sure that we're well connected.
Yes.
Okay, good. So grants to non-501c3s, expenditure responsibility. This is a term that you're going to hear a lot if you do grants to anything other than your plain vanilla 501c3 public charity. And what this is meant to ensure, these are a series of requirements that are meant to ensure that a grant will be used for charitable purposes. This almost mimics, from my perspective at least, fairly standard best practices in grant making. So the first step is you have to do some pre-grant due diligence to determine whether the grantee has the capacity to undertake the project, and whether the project itself is a charitable project that you're funding. Then you have to have a written grant agreement. First, that specifies the specific charitable project that you'll be funding, because the grant has to be restricted to that charitable project. And then it has to include a few other provisions that are required by the Treasury regulations, primarily around what the grantee cannot do with the money. So it can't use it for non-charitable purposes. It cannot use it for advocacy and lobbying. It would have to repay the grants. Those are the sort of things. Again, some of the things that are usually part of a fairly standard grant agreement. Then the grantee has to provide at least reports on at least an annual basis, and it has to track and keep records of expenditures related to the grants. And that's the reference to separately tracking the funds of the grantee. Doesn't have to put it into a separate bank account. It can track it separately on their bookkeeping system. And then finally, as a requirement for the foundation has to report the grant as an expenditure responsibility grant on its own Form 990 PF. Now, a reminder that, so again, non-501c3, so for example, you make a grant to a C4, a social welfare organization, or a C6 to a trade group, or a for-profit organization restricted to charitable purposes. It also is, within the scope, is also included charitable organizations with their application to the IRS pending. So, it might be an established entity, but their exemption application hasn't yet been approved by the IRS. So in that case, you need to exercise expenditure responsibility before making the grants to that grantee. And then once the application is approved by the IRS, you can basically drop the expenditure responsibility requirements. You'll still have the written agreement, and you would just continue that. But for example, you wouldn't have to report the grant as an expenditure responsibility grant on your Form 990 PF. Let me pause for a moment and just take a look at some these questions that may have come in. Okay, I think we're okay on the expenditure responsibility. Yes, one question. So, what happens if a charity, if a grantee dissolves, and they're not able to send you a final grant report? You have an international foreign charity that unexpectedly or expectedly goes out of business, and you're not able to find anybody at that grantee. You would do the best you can. I mean, that there is sufficient flexibility in the rules that in that situation, again, it's out of your control. You do the best you can. It would be great if the grantee gave you a bit of a heads up, so at least you can get reporting as close to date as possible. But that is, maybe you make a phone call. Maybe you write an email to them to say, look, we need a grant report. And then if they send it to you, great. If they don't send it to you, then you have documentation that at least you made some reasonable attempts to get the information, which is what the rules require. Same thing about, well, what happens if you find out that the grantee misused the grants? Again, you have to make a reasonable effort to get that money repaid. but you don't have to sue them, for example. You don't have to track them down and stand by the door and try to get that money back. You have to make some reasonable efforts to get the money back. And of course, if the grant is being paid out in installments and you have a sense or you get information that there may be problems with the grant, then you need to pause and suspend any future payments until you get some information from the grantee, and again, until you get comfortable that there are no concerns happening there. Quick question on, is expenditure responsibility required to a C4? Yes. So any grant to a non-501c3 requires expenditure responsibility. All right, let's see here. Let's take a look at so there's a question about, would you use expenditure responsibility to fund grassroots rural community groups that aren't 501c3s and are not planning to be? So you might have basically an informal group, an unincorporated association that's requesting money. So let me pause on that, and I'll and actually that's a good segue to into the next piece that I'll talk about, and I'll come back to that question as to one way to handle those kinds of grants. So giving to foreign charities, you have a few options here, three specifically. Expenditure responsibility that we just talked about. Then something called equivalency determination, which is basically a process that involves determining and concluding that the foreign organization is the equivalent of a U.S. public charity. Bottom line is that equivalency determination is usually going to require an opinion of legal counsel. These days, under the current IRS rules, you can have your accountants also make that determination, and some others. There's also a database of equivalency determinations that's building and building over the years called through TechSoup. And there's an equivalency determinations database, and they're collecting information about various foreign charities, and you can use that process as well in that database. And then the third option is to use an intermediary. And here you have a U.S. public charity that would be that is set up and has the capacity to make grants to foreign charities and projects. So what you're doing here is basically outsourcing the legal and administrative compliance of a foreign grant, a grant to a foreign charity, to a U.S. public charity. So an example is CAF America, for example, or Give to Asia, and other types of, these are large public charities that are now specializing in helping individuals and foundations to make grants internationally. Some have specialized knowledge of the requirements to make grants in Europe. Some are set up and have expertise in making grants to Asia, in Africa, and other parts of the world. And the reason that this arrangement works is, well, for several things. One, so again, these are public charities, so the private foundation rules to them don't apply. They usually follow most of the private foundation rules in terms of grant making, due diligence, and compliance. And again, they're set up to deal with these kinds of foreign grants. And so this makes it simple for you as a foundation. You give a grant to the intermediary, and then the intermediary approves the project, approves the grant that you want to make, the foreign charity that to which you want to support, and then distributes the grant. Of course, they do it at an administrative fee. So you want to give a foreign charity a $100,000 grant, and this U.S. intermediary usually charges some percentage of the grant as an administrative fee. So let me just talk a little bit about what kind of factors would you consider in deciding which of these options you want to go with. So expenditure responsibility for me is always the default, because we know that process is simple. It's a grant agreement. It's finding a specific charitable project you want to support. And these expenditure responsibility works best when you're giving oftentimes a one-off grant, and it's very flexible. The equivalency determination process works well when you have or want to build an ongoing relationship with a foreign organization, a foreign grantee. So it won't be just a one-off grant, but you might be making a grant over 5 years or multiple years, and you may want to keep supporting them over the years. Then equivalency determination, at least in my view, makes sense because you can do it once. You update it annually to confirm whether there's any significant changes have occurred at the grantee. But then once you're done with equivalency determination, you treat the grantee as the equivalent of a U.S. public charity. Somebody in the chat room reminded me that community foundations are also an excellent example of intermediate organizations that can facilitate international grant making. They're often set up, and it's always useful to check with those. So the intermediaries, and talking about community foundations, one of the advantages of intermediaries is not just the legal and administrative compliance that they're able to offer for foundations in facilitating the grant making, but they're often, as a result of doing this work, they often build up programmatic expertise to help sometimes vet grantees, give you some ideas, connect you with other foundations that are interested in maybe similar projects that you're funding, and connect with grantees. Donor advised funds is another example of an intermediary that is set up and that can again process through a foreign grant making. You can do that through a community foundation. You can do it through a national type of donor advised fund. And again, recall, we all know that a donor advised fund is treated as a public charity because the sponsoring organization of the donor advised fund is a public charity. Let me just say one more thing about giving to foreign charities. So we wanted to cover the legal private foundation compliance rules here, but as you see on the slide under the using intermediaries, so there are a lot of sort of non-tax compliance requirements that may come into play when you're giving a grant to a foreign charity. The one that almost everybody's familiar with is the anti-terrorism compliance, right? The list checking. There could be others. For example, some banking compliance rules. You want to make sure, depending on what area of the world and what countries you're working with, you want to make sure that they're not part of a sanctions list. Usually, if you're working through your own financial institution and making grants, your bank and your financial institution is going to be a very good stopgap in doing a lot of these banking and financial controls, because they're simply not going to be transferring money to any organization or a country, for example, that may have some flags associated with it. Okay, so that was international grants in a nutshell. Giving to private foundations briefly. So there are two rules here. You have to exercise expenditure responsibility if you're giving a grant to another private foundation. And if the grantee foundation also happens to be another non-operating foundation, as opposed to an operating foundation, which is a foundation that conducts its own direct charitable programs, you have to require that the grantee foundation distribute the grant that you're giving the grantee within 12 months of the close of the tax year in which the grant is received. And if you don't do that, then you cannot count that grant as part of your payout requirement. Now you may ask, well, why are we talking about grants to other foundations? This usually never comes up. It doesn't come up frequently, absolutely. We've definitely been getting questions, interestingly enough, more and more, to my surprise, about these situations. And it comes up in donor collaboratives, which is always very nice to see. It usually involves having one foundation in a community that is thinking about taking the lead on a project or on a grant-making project, but other foundations are also interested in supporting that project. And for a variety of administrative, programmatic, and other reasons, it may make sense for all the funding to go through this, let's call it the lead private foundation. So that's, in this case, that this issue may come up as to how do you make a grant to another private foundation. I always like donor collaborators. I think they're a nice thing to do, so this is why we wanted to raise this issue. Okay, next is grants to individuals. So grants to individuals are divided into, I like to think of them as being divided up into two broad categories. Those grants that require advance approval from the IRS, and those grants that do not require advance approval from the IRS. The grants that require advance approval are your scholarships, travel fellowships, and research grants to individuals. So, these are your typical, as a graduating high school senior, you want to give a scholarship, and in order to do that, you have to be set up and approved for that program by the IRS. What does that mean? Well, you can do it in two ways. One is oftentimes if a foundation expects that they'll be making grants to individuals and they're a new foundation, they will request that advance approval as part of their exemption application with the IRS. If it's an existing foundation and the foundation wants to start a new program for grants to individuals, then the foundation has to submit a sort of a supplementary request to the IRS that is that describes in detail what is the program, how you're doing it, and primarily what the IRS is going to be interested in is what are the criteria that you're using to approve the to select individuals and then to approve and make awards. And primarily what the IRS is looking for is that you're basing your selection criteria on objective and non-discriminatory basis. Now, objective and non-discriminatory has, it can have multiple meanings, and it's not meant to, for example, prevent a foundation um, from restricting grants to certain, disadvantaged groups, or to give them, say, we want to give scholarships for to support women in the sciences. You want to support women graduate students in the sciences, etc. So again, if the overall program that you're funding is charitable, there can be restrictions that are in view and in light and supporting the charitable mission of your grant individual. Then the other types of and then one last thing about the approval process. What ends up happening is the IRS then approves your application and your program, and then this question that comes up 2 months later or a year later is, well, we've tweaked our program somewhat. We've made changes to it. We want to expand the scope of recipients. We want to change the amount of money that goes that individual is receiving. So instead of giving $25,000 grants, we want to give $300,000 grants. So as long as the overall program is materially the same, you have flexibility in relying on that previous approval from the IRS to continue to use that and rely on that for changes to your program. So I tend to view it as, you're changing the number of individuals that receive funding, the amount of funding. I tend to view that as within the scope of your original request. If you're changing the fundamental purposes, the scope of the key charitable mission of your program, I think that you may need to take a harder look whether you have to, whether you indeed have created a new program that requires another approval from the IRS. So let me just scroll back up here and take a look at a few questions that have come in. Okay, let's see. So there's a question about having to get approval from your state if you're giving grants to individuals. I'm not aware of that. So if you are, but it can depend on the state rules. So for example, if you have received approval of your exemption application, from the IRS, for most states, your tax exempt status is derivative of that at the state level. And if you request advance approval from the IRS for a scholarship program, a new scholarship program that you're preparing and implementing, I'm not aware that you would need to get separate approval from the state for that new program. It's always worth checking your state. California in particular sometimes can have some traps for the unwary. But I'm not aware that you would have to get sort of an approval like the way you do it at the IRS. Let's see here. So this is a question about an employee assistance fund for employees. So let's talk about that. Let me talk about that next. And then I have another question on, are there similar restrictions on scholarships to individuals from public charities? So the the rules for public charities are different, right? Because these specific rules that apply to private foundations do not apply to public charities. So if a public charity starts a new scholarship program or a new program for grants to individual, you don't have to follow these private foundation rules. You wouldn't have to get advance approval from the IRS for a scholarship program at a public charity. However, the basic charitable nature of the rules, the basic criteria, and specifically that the awards must be based on objective and non-discriminatory criteria, that would also apply to public charities as well. So again, keep in mind that like private foundations, public charities have to, if they're grant-making organizations or if they happen to want to make grants, it has to be for a charitable purpose. And part of that charitable purpose is demonstrated by making sure that objective and non-discriminatory criteria are followed in the selection process. There's a question about if someone makes a grant to individuals outside of these parameters through a private foundation, is there a fine or gift that tax that is charged? So let me just pause on that point. We didn't include a slide on all the various private foundation excise taxes that apply from these rules. I think Exponent Philanthropy has a little cheat sheet on that, and hopefully maybe at the prior session that covered the sort of overview of private foundations, there was some review of the various excise taxes and penalties that can apply. But the basic answer is yes. So each of the private foundation rules basically has a penalty excise tax associated with it. So the grant-making rules, if you don't follow the grant-making rules for foundations, there is an excise tax penalty involved. If you don't follow the self-dealing rules, there's an excise tax penalty involved. If you don't make the required distributions, there is an excise tax penalty involved. So yes, it's important, and there are penalties involved. If the foundation keeps making and sort of violates the rules on an ongoing basis, then the IRS could view that as an egregious situation. Like especially if you are knowingly doing it, right? And the IRS can easily come in and try to terminate the foundation. And this also applies. Remember, at the federal level, the IRS is the authority in charge of regulating foundations. At the state level, the state attorney general has supervision and jurisdiction over foundations. Their set of rules is slightly different, but they also have the ability to oversee how foundations are managed and approve and work and operated. And they also have the ability to terminate and dissolve a foundation. Now, back to the Employee Assistance Fund. So we'll talk about that in two ways. One is there are special rules that apply if a private foundation that's affiliated with a company wants to give scholarships to employees or the children of employees of that company. And I'm not going to be able to cover those rules here, but there are some very specific requirements in that situation, including the number of scholarships you can give. And what is also important in that case is that the scholarship program not be set up in a way that is treated as an employee perk. And that sort of comes to the self-dealing private benefit issue that's related to the relationship between a company and a company foundation. And And then the second way that employee assistance funds come into play is what we'll talk about next, is the other types of grants that do not require advance approval from the IRS. And these are your sort of disaster relief, hardship assistance grants. These are grants to individuals in need or under special situations. These do not require pre-approval. So the simplest one is, disaster strikes, natural disasters, and you want to provide assistance. You want to take care of basic needs, right? Food, shelter, and some basic needs. Here you can give assistance, and you can give assistance to, broadly speaking, those affected. The condition, the way that these grants work is, of course, there's no condition, there's no requirement to apply or do anything in return for the assistance. And in the context of, and this is usually broken down also into two different buckets of grants. So the immediate assistance, right after a disaster strikes, that has very flexible rules. Again, you're basically taking care of human needs here. The IRS is not going to be second guessing. You can give a blanket to and hot soup to a homeless person and to a millionaire on the day of that the tornado struck or some unfortunate event happened. Now, if you're trying to provide assistance to address longer term effects, and this usually, comes up in sort of educational needs, psychological and physical needs. In those situations, you have to impose more stringent requirements that are tied to financial need. I mean, that's fundamentally what it comes down to, is that those kind of long-term needs you can provide support for as long as the recipient requesting those funds can show a financial need for those funds. Now, so the second type of grants that do not require IRS pre-approval is usually what we call these recognition awards. So, for example, a typical one is a teacher recognition or a literary prize recognition. So it's a recognition and award for past achievement. And as long as you're not requiring the recipient to do something as a result of receiving that grant, so you're not requiring them to write another book or write another play or undertake additional research. You basically said, and this usually happens through a nomination process and et cetera. I mean, basically the point is that, we think you're great. We wanted to recognize your achievement, and here's our appreciation. Please keep doing what you've been doing, but you can spend the money however you like. Again, those types of grants do not require any approval from the IRS. Now, let me just keep scrolling through some questions here. So it's, again, a leadership award, for example, one of the questions. Where does a leadership award fall into? And again, I think you have to think through this in terms of ask the question, are you recognizing an individual for past achievement? And are you imposing any future conditions on the recipient? So are you saying that the recipient that you have to use these monies in some particular way? You have to do something. You have to keep doing something. If you're imposing those kinds of future conditions on the recipient, then this would take you into the category of grants that require pre-approval by the IRS. If it's a leadership award where you're saying, these are the qualifications we view in a great leader, and we think that XYZ person has met those conditions, and we want to recognize that person for these qualities, then that sounds to me like you're not imposing future conditions, and this would be a sort of an achievement award. But again, so it's keeping in mind as to whether you're imposing conditions on the recipient. And all of these grants, right, we're still in the grants category, all of these grants are considered part of your 5% payout. So grants to organizations, grants to your C3s, grants to non-C3s, if you follow the rules, right, expenditure responsibility, equivalency determination, or doing it through an intermediary, all qualify for a payout. Grants to individuals, as long as you follow these rules, all qualify towards your 5% payout. So that's a good question. There's a question about, well, what about awards for paying off student loans? That's a good question. And so a student loan would be, I may need to follow up on that question, but off the cuff, paying off a student loan is basically a grant that is that wouldn't be part of a grant that requires pre-approval by the IRS. But you may need to think about tax implications to the, let me back up. That would be forgiving a loan, right? So you have a student that has loans from other sources, and you're providing assistance to pay off those loans. Yeah, I think you can treat that as a grant without restrictions. But that's a good question, and I think I may need to follow up with that. What we're often seeing these days and get questions about are grants, and we see foundations doing this increasingly, is providing not just the scholarship grants, but these stipends and living stipends. Because a lot of times foundations are thinking about funding students and individuals that may be all set with their scholarships, and they may be getting a free ride to a school of their choice in any case. But given the backgrounds that they're coming from, what they're really missing is additional living expenses and stipends that will help them both in their studies and to be able to take advantage of other opportunities that are frankly available to their peers at a university. So instead of having to spend their summer working, which we sometimes all feel that is it's a good thing to do and it's a good learning experience to do, but sometimes it may be useful to be able to give those students the opportunity to take an unpaid internship if that really furthers their studies and is something that they want to do. Again, those stipends, I think, are that would fall into the category of requiring pre-approval by the IRS, and that category of grants can also pose tax implications to the recipient. Most of these scholarship grants are not taxable to the recipient. Most of these types of disaster relief hardship grants, if they fall within a certain type of qualified disaster, are not taxable to the recipient. But living stipends and other sort of research fellowships often will be taxable to the recipient. So you want to pay attention to the tax implications for some of these grants to individuals. Okay. Giving grants to supporting organizations, right? We kept this at the end because hopefully not too many people do this, although grants to supporting organizations require some additional steps because they have been subject of abuse, and the IRS put in place now about 10 years ago some additional rules when a private foundation makes grants to individuals. What's a supporting organization? The supporting organization is a type of public charity that is a public charity because it supports another public charity. A common example is a university alumni association, or a type of fundraising organization that's affiliated with another public charity. Those kinds of organizations. There are many types of supporting organizations, and this slide gives you the basics as to the type of supporting organization that requires expenditure responsibility. And if you give it to these kinds of organizations, including this Type 3 supporting organization, the grant is not going to count towards your payout requirement. When you're doing your basic due diligence on your grantee to figure out, they're a C3 and what kind of C3 they are, they'll pop up. If it's a supporting organization, you'll know it'll pop up as a supporting organization, and then you just have to remember that there are maybe some additional things you need to look at when you're giving a grant to a supporting organization. A grant to a Type 1 there are three types: Type 1, Type 2, Type 3. Grants to a Type 1 and Type 2 are the easier ones. They all count towards your payout. Grants to a Type 3 non-functionally integrated organization does not count towards your payout. That's how the payout rules work. Lobbying and advocacy. So we wanted to just break this out into a separate sort of segment because it comes up and it's just easier to talk about it separately. I think we all know when you ask about, well, can a foundation engage in any advocacy and lobbying? And the usual answer is no, of course not. It's a good first start. But I think you can say, of course not, but let's just double check what we can do, because there are certain things that you can do. And to understand that, I think it's helpful to understand the use of the terminology, because that is usually what creates the most confusion in this area. The reason for that is because we use various types of terminology around lobbying and advocacy, both in the programmatic context, under the IRS rules, the tax rules, what is the tax definition of lobbying and advocacy and political activity. And then there are also Federal Election Commission rules and definitions around these terms. So educational activity, right? Educational activity is work and activity that is designed to influence how the general public and legislators are thinking about um, issues, policy issues. And educational activity is appropriate for C3s, and C4s also oftentimes fall into this category. And also for private foundations, right? All private foundations can engage in educational activities. Um, if you go up on the hill, if you do foundations on the hill, if you have ever participated in one of those foundations on the hill, which are great to do, both at the federal level, but also both at your local level, and doing it at the local level is incredibly important. It is you're up there and you're educating people, you're describing to folks what you're doing and what you're all about. That's an educational activity. You're engaging the public and legislators about and describing your programs. You're educating them about what you're doing. You're not asking for anything. You're telling them your story. You're telling them your story of your grantees. That's educational activity. Lobbying and issue advocacy, well, that is designed to influence specifically how a legislator votes, or indirectly through the voting of members of the general public, right? And now this is appropriate for public charities or C4s, but this is not something that that a private foundation can do, other than through a public charity grantee. And then the political activity, which is prohibited for all 501c3s, except that public charities may conduct voter education drives, and foundations may also then support charities that conduct voter education drives. This is just sort of, you can take a look at this later, but it's sort of a schematic as to how some of these rules apply. And specifically, if you look at it on the left-hand side, right, your charitable and educational activities, 501c3 private foundations, right, those foundations fall only in the charitable and educational space, right? We're not going over to the lobbying activities. Public charities, right? Public charities can engage in some minimal amount of lobbying activities. So that's fundamentally the difference between private foundations and public charities there. But what can you do, right? So as a foundation, of course, you're primarily giving grants to grantees. And, well, you can, of course, provide a general support grant, right? If a grantee engages in lobbying activities, but you're giving a general support grant to the grantee, you're not restricting it, you're not earmarking the grant, you have no control. You allow the grantee to decide how to use those funds. That is appropriate. The general support grantee, you trust the grantee, qualifies as a 501c3 organization. The grantee can choose to then use the money for lobbying activity within their own requirements. And that would be permissible. Now, you have to keep in mind, of course, that you can't have some sort of side letter, or you can't pick up the phone and talk to the grantee and say, well, but of course, we're giving you this general support grant, but wink, wink, nod, nod, we really want you to be using it for these kinds of lobbying efforts you're undertaking. That you cannot do. You also don't have to include, we sometimes get the question, and we sometimes run across grant agreements that just outright, as a standard template provision, prohibit the use of grant funds for lobbying purposes. And we're asked, well, is that provision required to include in a grant agreement? And it's not. You can give, again, a general support grant. You don't have to have a provision in your general support grant agreement that includes a prohibition on the use of the grants for lobbying. The one caveat to that rule is that if you are facing a grant with expenditure responsibilities, right? So if you're giving grants to a C4, if you're giving it to a foreign charity or some sort of other entity that requires expenditure responsibility, the expenditure responsibility rules do require a specific provision that prohibits the grantee from using the grant funds for lobbying. Now, let's just talk a little bit about exceptions to lobbying. And here, what we're talking about is at least three different, usually categories that come up that are not considered lobbying. So you could, in fact, obviously give a general support grant, but you could also give an earmarked, a restricted grant to a grantee specifically to fund these types of activities. So what are they? So non-partisan analysis and study. You can give a grant to a think tank or a research institution or a university to prepare a non-partisan analysis and research paper, an objective, non-partisan research paper, and you can earmark it for that. You can provide technical assistance, and technical assistance here has some specific meaning here, and what usually is the let's say a congressional committee or local committee legislative body asks you to come up and testify or give some sort of expert opinion on a particular issue on which you are an expert because of your funding or other work that you're doing. If you're invited to provide that kind of technical assistance, that will not be considered lobbying. And then you can also discuss and engage on broad policy issues. If you are engaged in work supporting early childhood education, you can talk about the policy issues around that. You can talk about what are pros and cons, how are some of the ways that these could be resolved and improved upon. And you could, one of the things could be talking about, having legislation on these issues would be great. Could you then advocate on specific legislation? No, you couldn't as a private foundation, but you can talk about these broad public policy issues. Another way to support advocacy of a grantee is to engage in what's called a project grant. And what this means is, so let's say you don't want to give a general support grant to a grantee, but you want to fund a specific project. And that project, part of that project happens to be lobbying undertaken by the grantee. So you have a project, let's say the budget of that project is $100,000, and the grantee wants to spend 20% of that budget on lobbying. So under the project grant rules, if you want to support that project, you want to give money to that project, you can do that. And what you would do is you would restrict your grants to that project, but you couldn't fund the entire project. You couldn't fund the full $100,000. You could only fund the non-lobbying portion of that project. And of course, the non-lobbying portion of that project in my example is the $80,000. That's the non-lobbying. The $20,000 is the lobbying. So you can give a grant to of $80,000 to that organization earmarked for that project. The question that comes up in this case is, well, what happens if there are multiple foundations funding this project, right? You're not the only one. The grantee is undertaking this project. They're fundraising. They're looking for funding, and you don't necessarily know that other funders are funding it, or you may know. You may know that 5 foundations are putting money into this project. Then you ask, well, the question comes, well, do you have to know what other foundations are, how much money other foundations are putting in, so that all the foundations in the aggregate are only funding the non-lobbying portion? And the answer to that is no. It doesn't matter what other funders are putting into the project. You don't need to know, and even if you do know, it doesn't matter. The only requirement is that when you make your grant, you cannot put in money that's more than the non-lobbying portion, irrespective of what other foundations are putting into the project. So that was lobbying and advocacy in a nutshell. And again, I think the overall point is there are definitely restrictions, obviously, on what private foundations could do, but there are a lot of things that foundations can do through grantees, and there are a lot of things that foundations can do when you start paying attention to the definition and the work that you're undertaking in asking the question of, is this really lobbying? Is this advocacy in terms of educational activity? We may be calling it advocacy, but is it, it sounds like just educational activity. So pay attention to that. It's important. And it can shed light on some of the limits and things that you can do that you may have thought was prohibited. So I wanted to talk a little bit as the final topic, and then we'll circle back to some of the questions on just grant-making policy. I always get a lot of questions about process, delegation, how does just the operation and management of grant-making. And what I try to encourage foundations is to adopt a policy, have something in writing. This doesn't have to be a huge undertaking. Do it in piecemeal. Do it as questions arise. You don't have to have a grant-making policy manual. It doesn't have to be 100 pages. Start here and there. Start with, again, addressing the questions. It often comes up as 2 ways. One is the just basic due diligence, right? What are the processes we should be following? And what are the processes we should be following in discretionary grant making, right? One of those topics that often come up with family foundations, but in other types of foundations as well. We want to have a discretionary grant making program. Is it okay if those individuals that are allowed to use the discretionary grants don't tell us anything about the grantees? When you put it that way, I mean, the usual answer is, well, no, it's not okay for them not to tell you anything about it. But of course, what they're asking is, what's the minimum due diligence that we need to do with a discretionary grant making program? Because part of the reason you're starting the discretionary grant making program is to kind of get sometimes the bureaucracy of the foundation out of the way, right? So then you have a policy that describes your basic legal due diligence. Um, for example, verifying the grantee's tax exempt status. How do you do that? And then describing how to go about, what is the nature of the discretionary grant making policy? What are the limits? What are the flags? What are the steps where you actually have to ask additional questions? There was a question about, well, where do we look to find out whether a grantee is a supporting organization? You're talking about these type 1s, 2s, 3s, functionally integrated type supporting organizations. It's a mess. How do we know what these are? Certainly one is looking at the 990. The Schedule A of the Form 990 of the grantee will specifically tell you what kind of public charity it is. If you do your verification of grantees through GuideStar, the GuideStar charity check will also tell you the specific tax exempt status of the grantee, including the supporting organization and what kind of supporting organization it is. So those are the kind of things that you would want to include in this process, and then it can then further prompt the folks that are doing the discretionary grants to ask questions. The second area that comes up is the delegation. Right? So having a policy that describes who's reviewing grants, who's making recommendations, who has final authority. If you have a foundation where there is a staff that is making recommendations or doing the vetting, sometimes you actually want to delegate certain grants as the authority to approve certain grants just to staff. There are some very large foundations that have fully delegated all grant-making decisions to the professional staff. The board is not at all involved in approving grants, and they've done it specifically for programmatic and other reasons. They don't want to be involved. The board in that situation is responsible for having reviewed and approved a grant-making policy that advises the staff as to what are the steps, what are the due diligence, what are the other things that are required in the grant making. So the delegation is one that comes up, and then oftentimes basic mission statement. Right, this sometimes comes up with family foundations, but others just focusing on what is the mission of the organization, even if it's not legally it's not a legal restriction, maybe not a legal restriction imposed on the foundation by the founder, but you may still want to narrow down the type of grant making that you're doing. Having that clarified in a grant making policy mission statement is helpful. Also very helpful in next generation onboarding and onboarding new board members. So the grant making policy is something that I find helpful in orienting both board members and staff in just oftentimes the questions that need to be reviewed. So let me keep asking the questions, and we have about 10 more minutes left. So let me just scroll back through and see what questions I've missed. And as I'm looking through this, Althea and others from Exponent Philanthropy staff, if you can, if you have any questions that I need to answer, please throw those out. And maybe also mention some of the resources that are available as well through Exponent.
Great. Thanks, Andras, for that presentation. And while you go through the questions that we have, Madeline will resend some that we've asked in the past, but I also want to encourage people, if you asked a question at the beginning of the presentation and it wasn't answered and you still would like to see an answer to that, you can go ahead and re-enter it in the chat. I also just want to do a couple of housekeeping items. We will be sending an updated PDF. We added in another slide at the end. So you will get that updated PDF in my follow-up email. You'll also get all of these resources plus any additional resources which were mentioned in the chat in that follow-up email that I will send tomorrow afternoon. I also want to just remind you again about our Signature Plus membership level. I should mention that, so this offers all the benefits of Signature membership plus guidance on legal matters that are relevant to operating a foundation and charitable giving. Andras is actually usually the person who answers those questions. So if you would like to have access to Andras all year round, up to 10 hours per year, then you should consider our Signature Plus membership.
Great, thanks.
Yeah, and then we can go back to Q&A.
So, yeah, just a few questions. So there was one question about private foundation grants from one foundation to another foundation, whether those rules that I mentioned of that, the out of corpus rule, where you have to redistribute grants by the grantee foundation, whether those rules apply when one foundation dissolves into another. And the basic answer is no, they don't. When one foundation merges, dissolves, splits, that kind of restructuring of foundations come under special rules, and so that out of corpus rule would not apply. That's a good question. But of course, you know, there are other rules that apply in those situations, so it can be a tricky area, but the out of corpus rules won't apply. And then someone asked the question about the database that I mentioned on equivalency determinations. And this is a database that's managed by an organization called TechSoup, tech as in technology, and soup as in chicken soup. TechSoup. If you Google TechSoup and equivalency determination, it'll come up, and it's basically a so it's this database that is being managed, and you can, as a foundation, you can join for a fee, and you can then have this organization actually do an equivalency determination for you. Now, instead of having to, let's say, hire an attorney or hire a CPA to do it, you can have this organization do an equivalency determination for you on a foreign recipient. And if let's say they happen to have already done the equivalency determination on that particular recipient, then you can take advantage of that work already being done. So it's sort of, the more people use it, the better it is for everybody, because it's meant to be sort of a resource that's available to the foundation sector. I believe there are several thousand equivalency determinations in that database to date. So it's a nice thing to have. Then there was also a question about the expenditure responsibility rules for unincorporated associations and local community groups. And I think I mentioned that, but I'm not sure if I sort of completed a response on that. And so the answer is, if you're not a recognized 501c3, right, and you're not planning on applying for tax exempt status, then that informal group or unincorporated association, community group, is treated as a non-501c3. If you want to make a grant to them, you would have to exercise expenditure responsibility. An alternative is to maybe look to see whether you could use an intermediary organization in that situation, and especially a community foundation, right? So a community foundation is likely to have some connection or be able to provide that assistance as an intermediary, and then you're just going to be making a grant to to that community foundation that then is able to provide that support to that local group. And that kind of arrangement is often called, and you may hear this term, and many of you I'm sure is already familiar with it, is a fiscal sponsorship, right? So when an existing 501c3 organization, like a community foundation, sponsors and serves as the fiscal sponsor of an unincorporated group or a project, that is something that you can do, and you have the grant being done through the fiscal sponsor, and you treat the grant to the fiscal sponsor as a grant to a public charity, and then the fiscal sponsor has legal control over the grant and manages it and provides the legal compliance. And again, all of these fiscal sponsors, for example, will charge a small fee for doing this. Let's see here. There's a question about. I think I'm getting a lot of pings and acknowledgments that community foundations engage in this area and are good ways to do this. Another good question about community foundations. So this is related to grants to individuals and scholarships. So do the rules apply? How do the rules apply when a private foundation wants to make a scholarship grant and they want to use a community foundation for that to manage a scholarship fund within a specific community? So there are a number of ways of doing that. If the community foundation sets up a scholarship fund and the community foundation is managing that, and the community foundation is the one that has the legal control over the selection process and the approval process and the final approval of the scholarships, then it's the community foundation's scholarship program, and the private foundation would be making grants to that scholarship fund. And that grant by the private foundation would be treated as a grant to a public charity. No extra due diligence. It wouldn't be a grant to an individual under the legal rules. It would be a grant to a public charity, in this case a community foundation specifically, for the purpose of supporting scholarships. So it won't fall within the grants to individuals category. It's a grant to a public charity for the purpose of supporting scholarships. It's very similar to, instead of the private foundation doing the scholarship program itself and administering the scholarship program itself, it wants to support a scholarship fund at a university. Same idea. Now, the university has a scholarship fund and the program. The university makes the final approval, but the foundation is providing support. That's a grant to a university. It's not a grant to an individual. Foundations colloquially often speak of it still as a scholarship grant, but it wouldn't be technically a grant to an individual, and those grants to individual rules won't apply. Let's see. I think there's one question that I am going to follow up on, but so let me pause there, and if you do have further questions, I encourage you to send them to Exponent. They can help answer, and they can usually get it to me to answer. Again, I also encourage you to take a look at that Signature Plus program, and hopefully you found this presentation insightful and answered most of your questions. Thank you.
Great. Thank you, Andras. And just a reminder to everyone, we will see you again with Andras in 48 hours for the close of the program in Module 3. You'll receive a new link in your email to access that module. And I'll also be sending around the recordings for today's session and the previous session as well. All right. Thanks, everyone, for joining. See you in a couple days.